Right. Before starting the session, I would like to give a brief introduction on myself. I'm Isuru Manawadu, mm, attached to the Department of Accounting, University of Sri Jadanapura. Professionally, I'm a fellow member at the Institute of Chartered Accountants of Sri Lanka. And I was graduated from the Department of Accounting, University of Sri Jadanapura, 15 years ago. Yeah. And in addition to that, I did my PhD in accounting in University of Malaya, Malaysia. The lecturing experience, more than 12 to 13 years. Right. I was invited to develop this mock paper and discuss the answers. So this particular paper developed by myself and Indunil sir. The auditing part was done by Indunil sir. Actually, when it comes to developing this particular paper, so we have taken some insight from the previous papers, and the case study pre-seen has been given as last examination paper, right? There is no change because of the time limitation and the request. We have given the same pre-seen, and the unseen also more or less similar, right? More or less similar. And we have selected a couple of standards based on the syllabus and tested comprehensively. For an instance, LKAS 40, investment property, there was a question on the application of investment property standard. Then SLFRS 16, leasing. So there was a question on that, the time value of money application, how you should calculate lease liability and right of use asset. Then there was a question on SLFRS 9, financial instruments. Not only one question, there are two questions on financial instruments. This advanced business reporting paper consists two aspects: financial reporting aspects and auditing aspect. Financial reporting 55% and auditing 45%, right? The auditing aspect already covered by Indunil sir. Let me cover questions on financial reporting. Question number 1 and question number 2, right? Based on the time given, we will try to cover as much as possible. Right. I would start with, let me show you the question. Right. First, we'll take questions from leasing standard. We'll discuss question number 2. Question number 2, part 1, SLFRS 16. Yes, already you have answered for this particular question, right? In the examination day, mock examination day, you have answered already. Let me tell you the exact question number. Yeah. Question number 2, part A. Question number 2, part A. Right. Nova PLC entered into a lease agreement for a period of 5 years to acquire property in Malambe to be used as a showroom. The agreement stipulates an annual rental payment of 500,000 payable at the start of each year. Start of the year, that's very crucial. Normally, you will be given questions end of the year. But here, examiner has given you start of the year. That means installment will be paid beginning of the year. Accordingly, the first payment was made at the beginning of year 1. Beginning of year 1 in the sense year 0. Right? We'll draw a timeline like this. Year 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. Okay. Beginning of the year in the sense, beginning of year 1 means year 0 here. Right? Let me read the first bullet point. The lease includes an option for Nova PLC to extend lease term by an additional 5 years. So initially 5-year period, then another 5-year can be extended at an annual rental of 550. The rent earlier 500,000 for the first 5 years. Then if we extend the same agreement for another 5 years, the second 5 years, the rent is 550 per month. Also payable at the beginning of each year. At the lease commencement, Nova PLC determined that the property's location is strategically critical for its operations, and there are no comparable alternative premises available in the vicinity. Right? That means why that information has been given. They will be renewing or continuing using that particular property. There is no alternative in that manner. Right? So that's why that information has been given. With that information, we can conclude that the total lease term is 10 years. Total lease term is 10 years. Okay. Nova PLC applies the cost model to measure right of use asset. The remaining useful life of the property, 20 years. 20 years. SLFRS 16 explains how we should do the depreciation on right of use asset. In order to depreciate right of use asset, we should give whether legal ownership is transferred to lessee at the end of the lease term. Right? if the legal ownership of the asset is transferred to lessee by the lessor, depreciation should be based on the useful life of the asset. Useful life of the asset. The reason is the asset or the right of use asset will be used even after the lease term because legal ownership has been transferred. Right? If the legal ownership is not transferred from lessor to lessee, then even though you have been given useful life of the asset, we cannot use, as lessee, we cannot use the entire useful life of the asset, right? Therefore, we need to depreciate that particular right of use asset, the lower of useful life and the lease term, right? I hope you understood that. If that particular information is not given, difficult to depreciate. Okay. Right. In this case, the useful life of the asset has been given and the lease term has been given. Initially 5 years, then there is option to renew for another 5 years. So maximum 10 years. Maximum 10 years that they are using the premises. Right? Okay. Third bullet point. At the start of the lease, Noah PLC incurred and paid a commission fee of 50,000 to the agent who facilitated the lease arrangement. The company's incremental borrowing rate is 13% per annum required. Advise Noah PLC on the initial and subsequent measurement of the above lease in the books of company as specially for 16 leases together with the required calculations. Right. In this case, 50,000 commission fee has been given. What is that? That is called initial direct cost. Initial direct cost of 50,000. That's part of cost of right of use asset. Part of cost of right of use asset. Right? Okay. Do I need to remind things in SLFRS 16 before directly giving the answer for this question? Or can I get your view on that?
So the doubt is, will the time allow to cover the entire paper if you go like that?
Yeah, so my plan is question number 1 and the 2 will be covered today. Then question number 3, unseen, would be covered tomorrow.
Okay, sir. I thought you are covering the entire paper today.
Because time is not enough.
Yeah.
That's how I plan. If you can, remind things through the explanation, that's okay. Then so directly we'll go to the answer then. Right?
Okay, sir.
Right. Okay. Now in this case, there are 10 years. Important thing in this case is the installments are paid beginning of the year. So when first installment is paid, first installment is paid here, 500,000. So I will write in different color. 500,000 here, first one. Second one here. Third installment here. If we pay first year 0, that means beginning of the first year, we are allowed to use the property, this one. Then again, we need to pay another 500,000 to use the asset for this year. Right? Then this is the third installment. This is the fourth installment. Then this is the last installment in the first phase. Because until 5 years we can use, no? Until 5 years we can use in the first phase. This is how the installments are paid. Right? Then as this company continue to use the asset for next 5 years, we'll write the cash flows. Beginning of next year, 550, no? We need to pay this amount. Then $550 here. 550. Here 550. Fourth installment. Then 550 here. Okay. Beginning of the 10th year. Beginning of the 10th year in the sense, end of 9th year. No? End of 9th year, last installment will be paid. Once we pay 550 here, end of 9th year, we can use the property till 10th year. Did you understand that up to that point? These are the cash flows. Is that clear?
Yes.
Right. Now we can go to accounts. We can go to accounts. Right of use asset. Lease liability. Right of use asset and lease liability. Okay. So we need to recognize initially. Okay. What is the lease liability of this transaction? We need to take the present value of all these cash flows. We need to take the present value of all these cash flows. My question, do we need to pay interest on this 500,000? Do we need to pay interest on this 500,000? Tell me.
No.
No. So we have paid that amount now, year 0. Year 0. Right? Year 0 in the sense, now 1 rupee equals 1 rupee. Okay. So therefore, we need not to pay any interest on that. So that's similar to down payment, more or less similar to down payment. So we'll write it like this. Cash credit, right of use asset debit. Cash. We have accounted this, right? Theoretically, that's correct. Theoretically, that's correct. Cash credit, right of use asset debit. In addition to that, this entity has paid 50,000 initial direct cost. Cash credit, right of use asset debit. Again, cash here. Right? Then you need to calculate the present value of all these cash flows. Present value of all these cash flows. Take the present value. Discounting rate has been given. Discounting rate, how much? What is the discounting rate? Or the incremental borrowing rate is 13%. Incremental borrowing rate is 13%. Right? Now you need to calculate it. You need to calculate the liability. How we are going to calculate? Now year zero cash flow already we have recorded in the right of use asset by using double entry. So I told you the double entry, cash credit, right of use asset debit. Very simple. Right now, so there is a specific cash flow, 500,000 for first 4 years, right? Year 1, year 2, year 3, year 4. 400,000, 500,000. Year 1 to 4. What is the cash flow? 500,000. Year 1 to 4. Then year 5 to year 9. Don't take mistakenly year 10. If we are taking year 10, that's wrong. That's wrong. Year 5 to 9. Cash flow 550. 550. Discounting factor. Discounting factor. Now, if we are taking now year 1 to 4, same cash flow, no? That's why I have taken year 1 to 4. If you take accumulated application, you need to multiply by annuity factor. Do you know what annuity factor is? Do you know what annuity factor is? Are you aware about annuity factor? Okay, don't worry, I will tell that. Now, in this case, year 1, 2, 3, 4, 5, 6, 7, 8, 9. There are 9 years. Cash flows. Cash flow 500,000. 500,000. 500,000. 500,000. 550 here. 550 here. 550 here. 550. 550. Then discounting factor 13%. I hope you are aware how to calculate discounting factor. Present value equals future value divided by 1 plus r power of n. You will be getting present value. So this equation is derived from future value equation. Future value equals present value 1 plus r power of n. Please write down this. Give me 1 minute, I'm getting a call. Right. Okay. Future value equals present value 1 plus r power of n. From the same equation, we can derive present value equation, right? Let's say you will be getting 1 rupee at the end of the year 1. 1 rupee in the sense future value. We need to calculate the present value. So I wrote 1 as future value here. Okay. 1 plus R. R is 13%. Year 1. What is the present value of 1 rupee that we will be receiving or paying at the end of the first year? Take your calculator and calculate. 1 divided by 1.13 power of 1. 0.884. 0.884. Right? Similarly, you can calculate next year. So you can put 2 here. What is the present value of 1 rupee, which will be receiving or paying at the end of the second year at the rate of 13%? What is the answer here? 0.783. Next, 0.693. Next, 0.613. Next, 0.542. Next year, 0.480. Next, 0.425. 0.376. 0.332. Now, if you are given 20 years, then what you need to do? You need to do the same thing for 20 years. Then you are wasting your time. Wasting in the sense only this particular question can be attempted. Right? So that's why we wanted to apply annuity factor. Annuity factor means the total of discounting factors. Total of discounting factors. As year 1 to year 4, same cash flow. That's why I wrote 1 to 4, 500,000. Take the totals of these discounting factors. That's called annuity factor. Then again, year 5 to year 9, different cash flow, no? Different, no? Then you need to take the total of these discounting factors. Then you have to have 2 different discounting factors as different cash flows, right? 5 to 9, 550. If we are given entire 9 years, 500,000, then you can take the annuity factor directly for all full 9 years. But in this case, as 2 different cash flows, you need to calculate like this. Did you understand up to that point? Why I have written like this?
Yes.
Right. Now calculate and see the annuity factor. What's the total annuity factor for first 4 years? Can you please tell me? මේ ටික එකතුවයි මේ ටික එකතුවයි මට කියලා තියන්න මම ෂෝට්කට් එකක් කියන්නේ. Anyone? What's the total? Now there are 3 decimal places. 0.884 plus 0.783 plus 0.693 plus 0.6 2.13, 2.973, right? 2.973. Same answer can be taken. Same answer can be taken by using annuity factor equation. Annuity factor equals 1 minus 1 over 1 plus r power of n over r. This is the annuity factor equation. So annuity factor equals 1 minus 1 over 1 plus r means 13%. First, you need to take up to 4th year. So year 4 divided by 0.13. Right. Now you can take the answer. First, you can, through the scientific calculator, you can directly get the answer by using any equations. Right. So easy to calculate like this. First, we can get the answer for the circled one. 1 divided by 1.13 power of 4. Press equal. Then you have received 0.613318 something. Then that answer can be deducted from 1. 1 minus answer equals. Then you have received 0.386681 something. There are many decimal places. Then that answer can be divided by 0.13. Then I hope you have received the same answer, 2.974. Here, couple of decimal places different because of rounding up error. Through the calculator, we can get the exact answer, most accurate answer. But here, small difference is there due to rounding up. Right. Now, I would write here 2.974. 2.974. The same time, we can multiply by 500,000 as that answer is there in the calculator. We can multiply by 500,000 and equal. You can get the present value of it. 1,487,236 approximately. Right. Okay, now you need to get the annuity factor for the year from year 5 to year 9. How we are going to get it? Now through this, you can calculate easily. Make එකතුව කීයද? What's the total of the discounting factor? මේ ටික එකතුව කීයද?
2.155.
2.155. Right. How you should get the answer by using this equation? How you should get it? Any idea?
First, we have to take it for 9 years and deduct the first 4 years annuity factor.
Very good. Correct. Nice answer. That's how you should do. First, you need to take up to 9, right? The annuity factor for full 9 years. Then you can deduct this part, right? Then you will be getting from year 5 to year 9. That's how you should do. Right. So we'll do it because within a couple of seconds, you can calculate the annuity factor by using this equation. Right. Tell me what is the annuity factor up to 9 year? 1 divided by 1.13 power of 9. 1 minus answer equal divided by 0.13. Up to 9th year, full 9 year, 5.13116. Did you get that answer?
Yes.
Yes. Then already you have calculated up to first 4 years. This is the answer, no? 2.9474. You can deduct it. Then you will be getting the annuity factor for the balance years, 5 to 9 year. So you will be getting, let me deduct 2.974. 2.157. 157. Okay. So that's the answer. 2.157. 2.157. Right. Now you can multiply by 550 because from year 5 to year 9, same cash flow. 550,000. 1,186,710. 1,186,710. Take the total. So that's the present value of cash installments, lease installments. Take the total. 2,673,945. Right. So what's the double entry for this? What's the double entry for this? Lease liability, sorry, right of use as a debit. Write the double entry, please. Right. Okay, what's the double entry? Right of use as a debit, 2,673,945. Lease liability credit, 2,673,945. Here, right of use asset, here lease liability. You need to change two names. Right. So initially, this is the cost of right of use asset. Take the total cost of right of use asset. What's the total cost of right of use asset? Total value, total cost is 3,223,945. That's the balance. This balance need to be depreciated over the period of 10 years. 10 years. Right? So this is the lease liability. This is the lease liability. In the beginning of the year, right? The beginning of the year, right? Then we can continue. Now, in the second part, there is a additional information is given. There is an additional information. advise Noah PLC on the impact on its financial statements if at the end of third year, the company decides to close down the showroom at the end of fifth year lease term. That means they are not going to continue the balance part. They are not going to continue balance part since it does not add significant value to the company as expected. Assume that Noah PLC's incremental borrowing rate at the end of third year is 15%. Now, earlier it was 13%. Now it has been increased to 15% at the date of end of year 3. Right? Right. Now, in the first part, what you need to do, you need to advise. That is higher order action verb. Higher order action advise. Right? In this case, 12 marks are allocated for this particular question. Action verb is advise. Now, we have calculated the answer for the first part. Right? Calculated the answer for the first part by considering entire cash flow. Entire cash flow. Right? Now we have done the things. Now you need to explain. You can explain as per SLFRS 16, lessee should recognize right of use asset, right? And lease liability. Then you can say right of use asset should be measured at cost, right? The cost consists of the present value of lease installments as well as initial direct cost. In addition to that, if there is a down payment, that's also part of right of use asset. In this case, you can write like this. In this case, 500,000 has been paid beginning of the year 1. Beginning of the year 1. So that has been considered as a down payment. Then you can say the total cost of right of use asset, 3,223,945 rupees. So first you need to calculate all these things, then you can write easily, you can explain. If we are providing only calculations, you are reducing or you are losing your marks. First, you should calculate and you need to explain. You need to explain by referring to the calculations. Right? You need to explain what you have done by complying the standard. Complying the standard. Right? Okay. Now, second part. How you are going to continue second part? Second part is comparatively complex. Comparatively complex. How are you going to do that? Let me draw the timeline. Year 0, 1, 2, 3, 4, 5, 6, 7, 8, 9. Right? So 500,000, 500,000, 500,000, 500,000, 500,000. These are the cash flows. In this case, no any interest because we have paid beginning of the year 1, meaning year 0. That's like down payment. Then what has happened? From this year onwards, 550, no? 550, 550, 550, 550. Now what they are going to say, what they are going to do, they are not going to renew. They are not going to renew the lease agreement for second 5 years. No, they are going to finish. They are going to finish from here, right? This should be the last date from here to here. Okay. Now, as the cash flows are paid beginning of the respective years, last cash flow is in year 4, end of year 4, right? Once we pay this 500,000 in this date, we can use the property till end of 5 years, right? So this would be the last cash flow. And what now, when entity has taken that particular decision, when entity has taken that particular decision, tell me. Year 3. This is the date that they have taken the decision, right? How many years, how many cash flows from this particular date? How many cash flows? Only one cash, only 1 year, right? Now, there is a change. There is a change. This change is what? Policy change or estimation change? Policy change or estimation change? And what is the applicable standard? Yes, they have changed their plan. Initially, they were thinking they will continue till 10 years. Based on that, we have calculated the present value. And we have already accounted. But now, they are going to change it. They are not going to continue. Right? So, what is the applicable standard for such thing? LKAS 8. LKAS 8. LKAS 8. Accounting policies, changes of estimates and errors. So this is an estimation change. Estimation change. When there is an estimation change, that should be adjusted respectively or prospectively. Retrospectively or prospectively. That should be adjusted prospectively. Prospectively. Right? That should be adjusted prospectively. That means from the date of change, we should adjust. From the date of change, we should adjust. Okay? From the date of change. Meaning we need to continue till third year. We need to continue till third year. Right? Now here we have accounting balances in the beginning of the year. Now lease liability, that's the value for the beginning. Then we'll continue for up to third year. And right of use asset also can be taken up to balance at the end of the third year. So we can calculate it, right? Okay, we'll do it. Can you please tell me the interest for the first year? Interest expense for the first year? So this is the answer for the second part. This is the answer of the second part. Yes, what is the interest expense for the first year? From here to here. You need to get the interest of 13%. 13% on 2.67 million. 2,673,945 multiplied by 13%. 347,613. Right. That is the interest. Double entry, interest expense debit, lease liability credit. And at the end of the year one, so there is a cash flow, 500,000 will be paid. Cash. Then take the balance. What is the balance? First year balance. Can anyone tell me the balance? $2,521,558. Did you get that answer? Did you get that answer?
Yes.
Right. We'll do the same thing for the second year from here, this particular period. එකත් ගන්න. Now, this is the loan balance or the capital balance, the beginning of the second year, beginning of the second year, right? Multiply 13%. Multiply 13%. What is the interest? 327,803. Right. Okay, that's the interest. Then we'll pay this 500,000. End of the second year, we need to pay 500,000. Cash credit, lease liability debit. Take the balance. Balance at the end of the second year. 2,349,361. Balance brought forward. Right. Now, we'll do last year before the change. On this particular date, there is a change. So we need to get the balance on this particular date. No? So we'll do the calculation for another year. So what is the interest for the third year? What is the interest for the third year? 2,349,361 into 13%. 305,417. Did you get that answer? $305,417. I hope you have received that answer. So I'm explaining by giving you some time for you to write the answers, right? Right? So you need to get the hands-on experience. Don't just write the same answer that I'm writing on the board. No point. No point. So you should calculate and see independently. Right. In the year 3, we should pay the same cash flow, 500,000. We'll pay this amount, cash, 500,000. Now get the balance. So what's the balance? 2 million, 2,154,778. Did you get that answer?
Yes.
Right. Okay. Now, what is the right of use asset balance at the end of the third year? At the end of the third year. So I will erase this amount. So already we have calculated it now. Carrying value of right of use asset at the end of third year. How we are going to calculate it? The carrying value, sorry, the cost of the asset in the beginning, 3,223,945. No, this should be multiplied by 10. Then if we depreciate 3 years, the balance useful life is 7 years. No, then you can multiply by 7. Then you will be getting carrying value of the right of use asset after third year. I hope you understood what I did. So I have taken the remaining useful life. After, if we depreciate up to third year, the balancing useful life is 7 years, no? Right? So, what's the answer? 3,229,45 divided by 10 multiplied by 7. 2,256,000. 76. 225,075. Kia දෙන්න පුතා? 225.
2256762. 2256762.
762 ne?
Yeah.
762. Hurry. 2256762. Yes. This is the carrying value at the end of third year. Now you have taken balances of right of use asset and the lease liability up to third year. Then in the method. Then over in the method. Right? As per the agreement, now there is a change, no? There is a change. Then මෙන්න මෙතෙන්ට අරගෙන ඇවිල්ලා තියෙන්නේ. You have taken up to this point. Both right of use asset as well as lease liability. Harry? Now you are going to apply LKAS 8. LKAS 8, accounting policies, changes of estimates and errors. Okay. In this date, entity has decided not to continue balance 5 years, and this agreement will be finished at the end of the 5th year. Then you can understand last payment. තව එක payment එකක් කරන්න තියෙන්නේ. ලක්ෂ 5යි. තව එකම එකයි ගෙවන්න තියෙන්නේ. Right? So already, so we have paid this 5,000 නේ. තුන්වෙනි අවුරුද්ද අවසාන වෙනකොට මේ ලක්ෂ 5 ගෙවලා ඉවරයි. We have already paid. No doubt at all. හරි? Because they clearly said this change happens in the end of third year. Change happens in end of third year. Right? එතකොට, so only one payment remaining. In addition to that, they have changed so there is a change in the incremental borrowing rate as well. Now, new rate is 15%. New rate is 15%. New rate is 15%. දැන් අපි ඉන්නේ මෙතනනේ පුතා. මෙතන ඉන්නේ. There is another cash flow. ඒ කියන්නේ තව අවුරුද්දකට පස්සේ මෙතනනේ ඉන්නේ අපි දැන්. මෙතන එක අවුරුද්දකට cash flow එකක් එනවා ලක්ෂ 5ක්. එහෙනම් මෙන්න මේකේ present value එක ගන්න 115ට ටක් ගාලා 115ට ගන්න. What's the present value? And that would be the liability, right? That would be the liability. How much? 1 divided by 1.15. The discounting factor 0.8695 multiplied by 500,000. What is the present value? 434,783 approximately. On a decimal line කරලා ගත්ත එක. This is the liability on this date. Okay? Because on this particular date, there is only one cash flow to be made, to be paid or rather. On this date, there is a change in the incremental borrowing rate, 15%. Right? As a result, this should be the liability on this particular date, the end of third year. This should be the real liability. But as per the calculation, lease liability, what is the balance? What is the balance now? What is the balance? කීයද අපිට ඉස්සෙල්ලා ආවේ? 2,154,778 නේ. තව එක මෙතන ලියා ගන්න ඉඩ නැති නිසා 2,154,778. Right? Okay. And you have the right of use asset as well. You have the right of use asset as well. You have calculated the carrying value at the end of the third year after doing our depreciation and all. Okay. Right. Now, what would be the adjustment on this? As per new change, your liability should be 434,783 on this particular date. But as per the accounts, you can see 2,154,778. So what you should do on this? You need to take the difference. A difference එක අරගෙන මොකද කරන්නේ? දැන් මෙතන මේක වැඩිනේ liability එක. Liability එක අඩු කරන්න වෙනවා. කීයද difference එක කියන්නේ? 2,154,778 778. What is the difference? 1,719,995.
Yes.
Is this the difference?
Yeah.
Hari. Make a double entry කියන්න කල්පනා කරලා. What's the double entry?
Lease liability debit ROU asset credit.
Yes, exactly. Yes. That's the double entry. මේක අනින් reverse කරන්න ඕනේ. ROU එක right of use asset as well as lease liability. මොන මන් දානවා entry දැන් 1,719,995. 995. Right of use asset. එක double entry right of use asset එකට තමයි set වෙන්නේ. The right of use asset එක මම මේ හැටි ගහන්න. Already we have the carrying value 2,256,000 කීයද ආවේ? 762 නේ. That is the balance. මේක 9 කරන්න. 1,719,995. Lease liability. Here right of use asset. Okay. Right. Now you have adjusted. So this is the required adjustment. End of third year. End of third year. End of third year. Right now we have taken the change. We have taken the change. Right. Now what you need to do? මෙතෙන්ට ඇවිල්ලා තියෙනවානේ. හරි. And you have taken 15% as well. Now on this particular date, what's the liability? What's the liability? The make account balance growth kiya denne. What is the lease liability on this particular date? What is the liability on this particular date? කිය දෙන්න මේ දෙකේ වෙනස නෙන්නේ වෙනස 434,783 නේ නේද? So what is the interest from third year to fourth year? What is the interest? මෙතන මෙතෙන්ට interest එක කීයද? Yes. What is the interest? Now you have taken the present value of last cash flow. The liability on this date is 434,783. So how to calculate the interest on this particular date for the remaining 1 year? So what is the interest? Make it apply කරන්න 15%. So what is the interest then? 434,783 multiplied by 15%. 65,217. 65,217. Right? Okay. Interest. Right. Now, at the end of year 4, end of year 4 or else beginning of year 5, දෙකම එකයිනේ. End of year 4 or beginning of year 5, last installment is 500,000. Last installment is 500,000. Cash credit, lease liability debit. Here cash. Make a balance වල යනවද බලන්න. check whether that account is balanced in terms of lease liability? Is there balance?
Yes.
Right. That's balanced. නේද? හරි. පුතා ඊට පස්සේ අපි මොකද කරන්නේ? Right of use asset. You can calculate depreciation for balance 2 years. Remain now. Now change happens on this particular date නේ. මෙදානේ change එක වෙන්නේ. එතකොට අවුරුදු දෙකක් තියෙනවා ඉස්සරහට යන්න. 2 years. Year 1, year 2. එතකොට මෙතන කීයද carrying value එක අලුත් change එකෙන් පස්සේ? What's the carrying value after the change? 2 million. කීයද එන්නේ පුතා? 2 million 200
536768.
556 නේ
536768.
2256 හරි 762 minus 1 million 19995 කීයද පුතා අර 536 586 ද 536
768.
768 හරි. So this is the carrying value at the end of year 3 නේ මෙදාටනේ. මේක depreciate වෙන්න ඕන අවුරුදු කීයක් තුලද? How many years remaining in terms of depreciation? කියන්නේ දැන් මේ වත්කම අපි තා අවුරුදු කීයක් ඉස්සරහට use කරනවද right of use asset එක? දැන් මෙදා ඉන්නේ. So year 1 and year 2, right? So this should be divided by 2. 536,768 should be divided by 2. So what is the depreciation for a year? Here.
268 384.
384. දැක්කද වැඩේ? So this is the answer for question number 2 part A. This is the answer for the part subsection 2. This one. Now you have seen the calculations. So you need to provide the calculations and all the activities that you have done should be explained because action verb is advice here. Action verb is advice. Right? So you need to elaborate, you need to write the things that you have done by your own words. Right? Then already you have calculated the answer. Then when you write, you can refer to your calculations. Then you can get maximum marks or the full marks, 12 marks. Okay. Right. Hope you understood the answer. Any questions on this before shifting into next? Right. Seems no questions. We'll go to next question now. Right. Now SLFRS 16 done. Now I would like to discuss SLFRS 9. There are 2 questions on SLFRS 9. So we'll go to that question. First, I will briefly explain SLFRS 9. SLFRS 9 basically explains recognition of financial instruments, derecognition of financial instruments, classification of financial instruments, measurement of financial instruments, impairment of financial instruments, right? So basically, those are the things covered under SLFRS 9. All the definitions are given in terms of financial instruments in the LKAs 32. Then disclosures are given under SLFRS 7. Okay. But there are interconnections among those standards as well as separations, right? In terms of recognition, derecognition, and measurement, particularly measurement, you should know the classifications. You should know the classifications, right? Financial assets and financial liabilities. There are three classifications: amortized cost, fair value through OCI, fair value through P&L. This one, amortized cost, fair value through P&L. That's how financial instruments are classified as per SLFRS 9. So this classification purely based on two things. Purely based on two things. Business model, and contractual cash flow characteristics. Contractual cash flow characteristics. Okay. Business model, yes, there are two models. What are the models? First one, invest and hold. Second business model, invest, hold, and sell. Invest, hold, and sell. Those are the business models. Contractual cash flow characteristics, in the sense, we have to have interest and principal payment. Interest and principal based on principal amount outstanding. Okay. Principal amount outstanding. So when it comes to contractual cash flow characteristics, we should apply time value of money concept. Time value of money concept. Time value of money concept. Okay. You should apply it. Because interest is as a result of the application of time value of money. No? Now, earlier discussion, we have calculated interest. Here, what we have applied. So discounting factors, we have taken the present value. And again, we increase by adding the interest, right? So this interest is calculated based on IRR. IRR in the sense EIR, effective interest rate. So effective interest rate. So this 15%, earlier we were using 13%. These rates are called effective interest rate. In other words, IRR, internal rate of return. Right? So that's why at the end, we have received 0 for lease liability. So there is no rocket science. So this is finance. Right? Time value of money. Time value of money. So based on time value of money concept, we apply future value and present value. future value and present value. When we are going to apply future value and present value, yes, we need to recognize interest based on capital outstanding. Based on capital outstanding, right? So that's what contractual cash flow characteristics means. So as per the standard, that says solely payment of principal and interest. Let me write it. As per the standard, it says solely payments of principal and interest. Right? Okay, let me show you that application as per the standard, because you are allowed to bring the standard book into the examination hall. So I have searched in the standard book solely payment, right? All these things are nicely explained. What is solely payment? Look at this. See, that's what I was telling. Financial assets shall be measured at fair value through OCI if both the following conditions are met, right? Business model, invest, hold, and sell. So that's what I said, there are business model, there are two types, invest and hold, and sell. Now this is a fair value through OCI, right? The first condition on the business model, the second one on contractual cash flow characteristics. That should be, now you can see the terms. Contractual terms of the financial assets give rise on specified dates to cash flows that are solely payments of principal and interest on principal amount outstanding, right? Then, so there are explanations on what solely payments of principal and interest on the principal amount outstanding. Let me show you some examples. Look at this. Section B41.11. Have a look on this. Following are some examples of contractual terms that result contractual cash flow that are solely payment of principal and interest on principal amount outstanding. Variable interest rate that consists of consideration for the time value of money, the credit risk associated with the principal amount outstanding during the particular period of time, and other basic lending risks and cost, as well as a profit margin. In variable interest, the interest can be vary as per the conditions. There is, so why we apply, why we calculate interest, as there is a time value of money. So that's the base, right? Time value of money. And there are risks, credit risks and all. Look at the second one, the contractual term that permits the issuer. Issuer and the holder, there are two parties, no? Debtor and creditor. Okay. Put a debt instrument back to issuer before maturity and repayment amount substantially. Now, let's say we have obtained a loan and we have given a loan. There can be both sides, right? There can be both sides. Let's say now we have taken a loan from a bank and there is a specific time period to prepay, no? but we have taken decision to settle early. We cannot wait till end of the maturity. We have taken the loan for 5 years, but we decided to settle within 2 years, right? So there is a payment. If there is a substantial payment on the uh, early settlement, this early settlement payment, when we settle the loan early, sometimes you have seen bank is charging a penalty. Bank is charging penalty, right? If they are charging like that, that means that's because of the time value of money. That's because of the time value of money. Because they have given loan for a specific period of time. But if we are settling before that time, there is a cost to the bank. Then customer should pay it, right? That's what explained in part B. Now you can read and then you can understand, right? Represent the unpaid amounts on the principal and interest principal amount outstanding, which may include reasonable compensation for the early termination of the contract. Reasonable compensation should be there, right? Because there is a cost. Bank has committed to the customer. Then if customer is settling early, there should be a compensation. There should be early settlement interest, right? Look at the third one. The contractual term that permits the issuer or holder to extend the contractual term of the debt instrument. Extension option. So that's what we have done under leasing. And the terms of extension option result contractual cash flows during the extension period are solely payments of principal and interest and the principal amount outstanding, which may include reasonable additional compensation for the extension of the contract, right? So that option also there, the extension of the period, then additional reasonable compensation should be there. Right. These are some examples for solely payment of principal and interest. Right. Okay, now we can go to question number 1, part A. Now look at this. As at 31st March 2025, Summit PLC held the following financial instruments. The company's accountant is uncertain whether these instruments meet the solely payments of principal and interest contractual cash flow characteristics test in accordance with SLFRS 9 financial instruments. Right. Now, there are 4 cases. So what is the action verb given? Assess whether each of the financial instruments described in items 1 to 4 meets SPI, solely payment of principal and interest, contractual cash flow test under SLFRS 9 financial instruments, again 12 marks. 3 marks each. 3 marks each. Right. Have a look. 1, 2, 3, and 4. Right. We'll read one by one. Then you can apply that particular test. Investment in a bond, maturing on 31st December 2029, which carries a variable interest rate determined based on prevailing market conditions. The rate is capped at 9 per annum. What do you think? This is a bond. This is a bond. That's a financial instrument. So there is a specific time period and variable interest rate is there. Annual interest rate is 9%. Okay, now you have read 3 examples as well. Right, read the second one. Investment in 5% convertible bonds that are redeemable in 5 years. Each bond can be converted at the option of the bondholder into 2 ordinary shares of the issuing entity at any point during the 5th year term. Now, did you see anything related to conversion? So there is a conversion option. Now, here we are talking about interest and principal on principal outstanding. So here they're talking about conversion. Now, you can remind what you have written in the exam. What did you write? Whether this is covered or pass the test, interest and capital outstanding test for this conversion. So there is a 5% convertible bond. Right. We'll read third one. Loan granted to another company. Loan granted to another company. That's an asset for the company who granted. Repayable in 4 years, fixed interest rate. Fixed, right? 4 years fixed. Borrowing, a borrower retains the option to prepay the outstanding principal and accrued interest at any prior to the maturity, subject to penalties specified in the loan agreement. Now, when you read this, you can remember or you can remind, you can go to that particular the standard application. So same thing has been given under examples. Third one, same thing has been given. Then you need to say whether that's complied with the test. Right. Read the fourth one. Loan provided to a related party with 5-year maturity, carrying below market interest rate when compared to similar lending arrangement available in the market. That there can be such things. There can be such things, we are providing loans to employees at concessionary rates below the market rate. That's what we are saying, concessionary rate. Even though we provide such loans, we need to account at fair value. Right? We need to account at fair value. Okay? But here we need to say whether there is interest and capital outstanding. Whether that test is pass or not. That's what we need to say. Okay? Right. Now we'll see the answers. Now purely the application of the standard. Now you have seen the examples. Right. So this is the answer of the first one. So just have a look now. Already we have discussed it. First one, contractual cash flows of variable rate instrument meet up SPPI test. Variable rate, now in the first case, they have given the variable interest rate. provided in the interest rate reflects the consideration for time value of money and credit risk. Since the variable interest rate is based on the market terms, it seems the above criteria is met. Because variable interest rate has been given, so therefore the first condition is met, that particular term is met. Since this instrument has an interest rate cap, it has features of instrument with a fixed interest rate as well. Through the interest rate cap, the variability of cash flows is reduced because interest rate cap is there, more or less fixed. Then the variability is limited. If we are obtaining on fixed interest rate, fluctuated, or the effect interest rate is fluctuated, the cash flow should be different, right? Such an instrument meets the SPPI contractual cash flow characteristic test. The first scenario, they pass the SPPI test, contractual cash flow characteristic test. This is the second one. Convertible option. Convertible instrument to be analyzed in its entire period need to be taken into consideration. Convertible things, it has both components, not only liability component, but also equity component is there. Actually, that has been explained as per LKAs 32. These are called compounded instruments. I hope you can remember that. Compounded instruments, right? The interest rate for this type of convertible note does not reflect only the consideration for time value of money and the credit risk. That's only one thing. Not only credit risk and the time value of money. In addition, the holder is exposed to additional business risk as the return is linked to value of ordinary shares of the issuer. Therefore, SPPI test is not met. So that's the conclusion. So not only time value of money and the credit risk, so there are some other factors to be taken into consideration. Therefore, SPPI test is not met. Third one. This is early settlement one. So have a look on this. Have a look. Contractual cash flows that are solely the payment of principal and interest on the principal amount outstanding are consistent with the basic lending arrangements. If the penalty is reasonable to compensate early termination, yes, we can say the loan meets the SPPI test as it is consistent with the basic lending arrangement. So even though there is early settlement, they have charged reasonable compensation for that. So it meets the SPPI test. Last one. Last one. So this type of things are normal in a business. Employees are provided concessionary interest rate loans, but we are recognizing them at fair value, right? The principal is the fair value of the financial asset at initial recognition. Accordingly, the fair value of the loan is the present value of the future cash flows using the market rate of interest. Market rate of interest need to be taken and take the present value, right? Take the present value. Any difference, the present value and the given value, that should be charged to P&L as an interest. As an interest. Okay. Let's say market rate is 13%, but employees are given 5%. There is a difference, no? When we calculate the present value, there is a difference. That difference is considered as the interest, right? Accordingly, based on the terms of the loan meets the SPPI test, right? So this particular question is developed purely from the study text or the standard book, right? You are allowed to bring the standard book, and in the examination hall, you cannot, turn to page and write the things. So before the exam, you need to, you should read anyway, and quickly you can go to respective section and write, right? If you are seeing them very first time in the standard book, comparatively difficult, right? Okay, question number 1, financial reporting part is done. Question number 2, part 1 is done. Now we'll take the balance question from financial instrument. We'll take this 5 marks. Question number 2, part C. Have a look on this. Please read this. This is also based on the classification. Classification. Provide accounting advice to the management of Jayden Holdings Limited regarding the appropriate treatment of the above transactions under SLFRS 9 financial instruments for the financial year ended 31st March 2025. 5 marks. Right? On 15th of June 2024, Jayden Holdings Limited acquired 300 voting shares of Zenith PLC at a price of 150 per share. So this one, equity share investment. No, this is an investment, acquired investment to the Jayden Holdings. That's an asset, financial asset. So there are 3 classifications of financial asset: amortized cost, fair value through OCI, and fair value through P&L. If you want to classify something under amortized cost, both business model and the contractual cash flow characteristic test should be achieved, satisfied. Business model should be invest and hold. That's the most powerful condition for amortized cost. Invest and hold. Let's say we invest something, maybe under debentures, under fixed deposit, and till 4 years. But if you are withdrawing your money before 4 years, you cannot classify that investment under amortized cost. Then you need to see the second one. Second one is fair value through OCI. So there is a sequential order. First, you need to see whether you can classify under amortized cost. If you are failing to do so, you can see the possibility of fair value through OCI. Again, failure, you can go to last one, fair value through P&L. Fair value through P&L. That's how it happens, right? If you can classify something under amortized cost, it gives financial strength to the organization, to the business. Financial strength, right? So therefore, the companies are trying to classify something under amortized cost because investors wanted to see, investors wanted to see financially strong companies. Okay. But there are conditions to be satisfied. So amortized cost method, business model and the contractual cash flow characteristics should be satisfied. Failing, we can see the second option, right? Now, share investments, you can understand now, are there any interest and capital outstanding for the share investments? There is no such cash flows. If we invest on shares, we will be getting dividends. We will be getting dividends if they have proposed dividends, if they have paid dividends. If they have not proposed or pay, we would not be getting dividends. In addition to that, we can get some capital gains if we sell the investment. Right? Those are the cash flows, but there is no such fixed cash flows. There is no such fixed, applying the time value of money things. No, nothing. Right? Therefore, we need to go to second option, time fair value through OCI. Fair value through OCI. Right? Okay. In fair value through OCI conditions, already you have seen. Invest, the business model should be invest, hold and sell. That can be applied to share investments. And second one, contractual cash flow characteristics should be there. But in terms of contractual, in terms of fair value through OCI, that contractual cash flow characteristics case is not 100% applicable. All the cases, right? But in the business, in the amortized cost method, definitely both business model and the contractual cash flow characteristics should be satisfied. Right, let me read the balance part. In addition, the company incurred a transaction cost of 1.25. When it comes to measurement, all classifications, initial measurement should be at fair value. All classifications, right? Fair value. No any change. Fair value, fair value. Transaction cost. If you classify something under amortized cost, transaction cost should be accounted financial asset itself. If you classify something under fair value through OCI, transaction cost should be adjusted or counted financial asset itself. If you classify something under fair value through P&L, transaction cost should be charged to P&L rather than the financial asset itself. Okay, so there is a transaction cost of 1.25%, the total purchase price. As part of long-term strategic plan, Jadon Holdings intends to gradually obtain controlling interest. A short-term investment. If they have the intention to get short-term gains, then the most applicable classification would be fair value through P&L. Fair value through P&L. Again, short-term profit motive fair value through P&L. But in this case, they have medium-term intention to get some controlling power of the respective company, Zenith PLC. Zenith PLC declared and paid interim dividend 2.5 on 15th of February 2025, despite the fact that fair value per share 175 as at 31st March 2025. And market price එක වෙනස් වෙලා. Fair value එක වෙනස් වෙලා. Management of Jayden Holdings has no intention to measure this investment at fair value through P&L. හරිනේ ඒක පැහැදිලි. එයත් ඒක කියනවා. There is no such intention. එහෙනම් මොකද කරන්නේ? This investment should be measured at fair value through OCI. That's the first conclusion. The initial measurement should be at fair value. 15th of June 2024 was the fair value. What's the fair value? කවුරු හරි කියන්න මට 300 ලක්ෂ 3ක් තියෙනවා කීයද ගන්නෙ 150ට මිලියන වලින් ගත්තොත් 45 million. Is that 45 million? $300,000 into 150, no? Yes, 45 million. This is the initial fair value, and you need to add 1.25 transaction cost. එතකොට කීයද 1.25 ගත්තම 45 million into transaction cost is 0.5625 million. Then total value, the beginning, 45 56 45.5625. Okay, million. That's the initial value with the transaction price, transaction cost plus initial fair value. Initial fair value. Then this dividend income, 2.5 into 300,000, 750,000. 750,000 dividend income received. What you need to do with that? This should be charged to P&L. Other income. So dividend income should be recorded under other income. If we know exactly this is a interim dividend, no, we have received. If we have received cash debit, dividend income account credit, that can be recorded on that way. The reporting date, 31st March 2025. The market price increased to 175 multiplied by 300,000. Then it increased to 52.5, right? Million. 52.5. So this is the new fair value. So fair value of the investment is 52.5. So you need to update up to this point. Then any change should be charged to OCI. ඒක OCI එකට දාන්න ඕනේ. Any change should be charged to OCI. එතන දැන් උඩ එක තියෙන්නේ කීයද 52.5යි ඍණ 45.56යි approximately කීයද එතකොට 6.94ක් වගේද fair value change. Fair value change. Did you get that answer? What's the fair value change? What's the fair value change? Based on this calculation, 6.94, ne? Yes. So this is the answer. This is the answer. So all these things were explained. Initial measurement, initial fair value plus transaction cost. That's why we have multiplied by 101.25%. So including the transaction price, then you will be getting 45.56 million. The dividend income would be recorded under other income, 0.75 million. That means 7,50,000 කියලා අපිට ආවේ. Then fair value change 6.94. That should be charged to OCI, other comprehensive income. Right. Okay. We have covered question number 2. Question number 2, part 1 done. Now we need to discuss part 2. Part 2. Part C already done. Right. Now we'll discuss part 2. That's on LKS 40. I will take 5 minutes break. Shall we take small break before starting this? Refresh and come. Right, okay. Now we can discuss LKS 40 investment properties. Investment properties. First I would be giving small explanation on LKS 40. Then you can remind what you have learned already. LKAS 40 investment properties. Right. When it comes to investment properties, definitions, you should know what is an investment property, IP. IP is a land or building, or part of building, which kept for renting purpose or capital appreciation. Renting purpose or capital appreciation, right? If we have, let's say there is a motor vehicle, we have given on rent. Is that IP? No. As per the definition, no. That should be land or building. That should be land or building or part of building, kept for renting purpose or capital appreciation. Let's say we have invested on a land and there is no intention. There is no any intention. We have purchased and kept. After a couple of years, we can sell. That's the intention. So the purpose is capital appreciation. Then that's an IP. That's an IP. That's an IP. Let's say there is a vacant building. Currently, no one is there, but organization's intention to rent it out in future. Still, that is an IP. There is an IP. Okay. Let's say there is a construction going on. The purpose of this construction is to rent this particular building in future. This construction is an IP. IP. Right? In IP measurement, there are two measurement bases, cost model and fair value model. Cost model and fair value model. Cost model more or less similar with LKA 16. More or less similar with LKA 16. Cost that should be depreciated based on the useful life of the asset. Cost model. Fair value model and the revaluation model. Not the same. There is a difference. Cost model, what we need to do is we need to take the fair value with each and every year end. And fair value changes should be charged to P&L. Fair value changes should be charged to P&L, no depreciation. In fair value model, no depreciation. Remember that, no depreciation. But in revaluation model, we do depreciation. As per LK 16. As per LK 16, we do depreciation as per LKA 16. Right? Okay. And accounting treatment also different. In the very first time, if we do revaluation and when there is a gain, that should be charged to OCI, other comprehensive income. But here, fair value changes should charge to P&L. Fair value changes should be charged to P&L. So there is a difference between fair value model and the revaluation model. Please keep those differences in your mind, right? And as per case 40, the definition is very, very important. You should identify what are the investment properties, what are not. And if that is an IP, the measurement either on cost model or fair value model. Right. With this small description, we can go to question now. Right. Now there are a couple of lands, right? Couple of lands and buildings. Urban Properties Private Limited is a real estate company with its financial year ending 31st March. As at 31st March 2025, UPL owned following properties. Land in Kaduwela. UPL purchased this land in May 2024, 10 million. That's the initial investment on the land. 31st March 2025, company had not yet made a decision regarding its intended use of the land. The net realizable value at the reporting date was 13 million, while that means they have not decided whether that's for reselling purpose or not. They have not decided, no. So then what is the purpose? Capital appreciation. Therefore, this is an IP. So net realizable value is given as this is a real estate company. For real estate company, lands are inventories. Lands are inventories. So that's why net realizable value is given. The fair value of the land also given. Also given. Let me go to last requirement. And there is a note. UPL prepares its financial statements in compliance with SLFRSs. Investment properties are measured using fair value model. Right, okay, fair value model. While land and building classified as property, plant, equipment are measured under revaluation model. Right, okay. You need to advise the management how these properties 1 to 4 would be accounted. Right. In property, in investment property, initial measurement should be at cost model. Initial measurement should be at cost. Subsequently, there are two models, cost model and the revaluation model. Sorry, cost model and the fair value model. Hari. That initially 10 million තියෙනවා. Subsequently, definitely fair value. දැන් මේ කියන විදියට. This is an IP. This is an IP. ඒක පැහැදිලි. එතකොට කීයද fair value change එක? 10 million minus what's the fair value change? Fair value change is 13.7 minus 10. 3.7 fair value change. That should be charged to P&L. This is an IP. This is an IP. The reason is this land is kept for capital appreciation. Kaduwela land is an IP. Right. We'll take second land. Land in Kurunegala. Read it. This land was acquired for 30 million with the initial plan to sell it in ordinary course of business. However, due to delayed economic recovery following economic crisis, UPL anticipated difficulty in finding buyers. As a temporary measure, the company leased out the land another business for use as a parking facility. Parking දෙන තැනකට land එක allow කරනවා temporarily. As at 31st March 2025, the fair value of the land was 34 million and net realizable value was 32 million. Right. මොකද කියන්නේ? Is this IP, inventory or PPE? Land in Kurunegala. What is your thinking? What is your argument in this regard? This land has been temporarily given on rent to parking facility. What do you think? Is this IP? Is this PPE? Is this inventory? Yes. Are you there? Very silent. Okay. They don't have intention to rent this particular land because of the difficulty of locating a buyer. They have given that particular land for a rent for the parking company on temporary basis, right? Once they identify a buyer, they will sell it. That particular land is kept for reselling purpose, right? So therefore, this Kurunagala land could not be identified as as an investment property. No, this is not an investment property. This should be identified as a as an inventory, right? Inventory should be measured cost or net realizable value, whichever is lower. The cost is 30 million here. Cost is 30 million. Net realizable value 32 million. Cost is lesser, so as per inventory standard LKS2, the value of this inventory is 30 million, not 32. The NRV is higher than cost, but we need to record this one under cost. Higher cost on net realizable value, which is lower as per the prudence concept. Right. Look at third one. Building in Kalutara. Building in Kalutara. Acquired in April 2024 at a cost of 20 million. The building has an estimated useful life of 30 years. Estimated useful life is 30 years. Okay. It was rented to 2 tenants under operating lease arrangement. Under operating lease arrangement, this particular building has been given on rent, but both vacated the premises due to financial challenges, both on by the continued economic downturn. The building was unoccupied as at 31st March 2025, and UPL was in the process of securing new tenants. The building's fair value at the reporting date was 22 million. Right. What do you think? Is this building is an IP or not? Currently unoccupied. Building was unoccupied. No tenants, but they are searching tenants. Therefore, this is an IP. This is an IP. This is an IP. Initial measurement 20 million. Subsequently, fair value 22 million. Fair value change 2 million should be charged to P&L. So all these things need to be written. Right. Last one. Building under construction in Homagama. Homagama. Construction cost incurred up to 31st March 2025 amounted to 20 million. Once completed, UPL intends to lease the building to several educational institutions. The property is being developed on a plot of land under land held under 50-year lease. 50-year lease. 50-year lease. ඒතර lease land එකක් උඩ තමයි බිල්ඩිම හදන්නේ. හරි එතන පොඩි කතාවක් තියෙනවා. There is a story which commenced on 1st of April 2024. UPL made a lump sum prepayment of 130 million at the start of the lease. Lump sum payment has been made. As of 31st March 2025, the fair value of the construction work completed was 23 million and the fair value of the leasehold interest in the land was 135 million. Right. මොකද කියන්නේ දැන්? The land was 50-year lease and on that particular land, the construction is going on. The construction, that particular building will be rented out, meaning that particular construction should be recognized as IP, okay. Then they incurred 20 million, but the fair value of the construction 23 million. So 3 million. That could be charged to P&L. Fair value change, that could be charged to P&L. Please write down them. ඊට පස්සේ there is a special section in the standard. ඒක තියෙන්නේ SLFRS 16 වල section 34. We'll go to that section and see. This is SLFRS 16. SLFRS 16, section 34. If you have the standard book, you can go to that particular section and see. Section 34. Right. මේ තියෙන්නේ බලන්න LKS 40 වල connection එකක් දීලා තියෙනවා. If a lessee applies the fair value model in LKS 40 investment property to its investment property, the lessee shall also apply the fair value model to right of use assets that meets the definition of investment property in LKS 40. හරිනේ. ඒක තමයි කතාව. එතකොට for the land also we can apply fair value model. Okay. As a result, what we can do, we can measure the land right of use. There is a leasing, no? There is a leasing. So what is the fair value of it? 135 near the fair value. Fair value of the leasehold interest land 135. Land 135. The lump sum payment that we have paid 130. So that has been recorded. No? Then difference between those two, 35, 135 and 130, the difference can be charged to P&L. Okay. Yep. That's the answer. Did you write down? this Homagama construction is an IP. IP need to be recognized as per the standard. Initial measurement 20 million at cost, and subsequently we can recognize at 23 million. The 20 and 23 million change should be charged to P&L 3 million. And there is an application on the lease hold asset. As per section 34 of the standard SLFR 16, if we apply fair value model to investment property, same thing can be applied to land. Leasehold land. So ඒ අනුව අපි එකත් කළා. 135 වලට රෙකෝඩ් කරලා 5 million P&L එකට charge කරන්න. Right. Yes. That's it. We have covered question number 1, financial reporting part. Question number 2, financial reporting part. All 3 sections are connected with financial reporting, right? And the balance one is case study, pre-seen and unseen. So that's purely 2024 December past paper. 2024 past paper. The reason for giving the same thing, the pre-seen, as per the guidance or the guidance given by CA, pre-seen is the previous question paper. Pre-seen is already published. So we decided to give that one. Then all the information, financial statements already given under pre-seen. Then the unseen also amended. There are few changes, few amendments, and more or less similar, right? There is no big difference in terms of unseen questions in the question number 3, in terms of financial reporting part, right? So we'll discuss that one tomorrow, right? Tomorrow we can discuss that part, maybe 8 o'clock. It will take maybe 1.5 hours or 2 hours to discuss, maybe 1 hour. We'll try to finish as soon as possible, because time is very important for you, right? Time is very important. My advice, now you need to write past papers independently, right? And see whether you can answer independently, and you need to score minimum 50 for the past papers. If you can score 70, 80, yes, that's what that's the level. In the real examination, definitely you could get because of the exam, that there is a stress level, no? Because of that, there can be slight change in terms of performance than the past papers, right? So your past paper score should be higher than 50, right? That should be done independently. Read the question and write the answer. Then you can see the abacus. Abacus in the sense suggested answers. All those things are available. And in addition to that, if you can do ACCA past paper questions, recent past paper questions, that also highly recommended. Definitely you can pass the exams, right? I take this opportunity to wish you all the best. Definitely you can pass the exam, and you can be a chartered accountant soon, right? Okay, with that note, we can conclude. Anyway, before that, do you have any question? Any things to be cleared? So almost 3 hours taken. Huh? Right. Your silence says no questions. Thank you very much for joining and listening. Again, I wish you all the best for your examinations and your future. Thank you very much and good night.